Welcome to The Explainer. I'm glad you're here today. We're going to dive into a massive, fundamental capital rotation that is currently completely reshaping global markets. Right now, we're seeing a fierce liquidity squeeze, putting intense pressure on traditional assets, while at the exact same time, capital is relentlessly flowing into a very specific AI oasis. If you follow the daily financial news, you know the volatility lately can be blinding. So today, we're going to cut through the noise. We'll unpack the underlying logic behind this massive capital flight, analyze exactly how corporate earnings are validating the AI megatrend, and most importantly, map out how you can defend your personal portfolio using strategic cash management and highly disciplined bottom fishing. Here is our roadmap for today. We'll start with the great liquidity shift, then move into how Micron is validating AI demand. After that, we'll look at treating cash as a strategic asset. And finally, we'll cover optimizing those core AI positions. All right, let's jump right into part one, the great liquidity shift, and track exactly how capital is fleeing a tightening market. The underlying logic of the current market is honestly undeniable. We are witnessing a sudden and severe outflow from traditional safe havens and alternative assets. I mean, look at the board. Gold dropped below the $2,400 mark, officially entering a technical bear market. Bitcoin fell below 60,000, and oil prices have just plummeted. So you might be wondering, why the aggressive liquidation? Well, as hawkish signals rise and money tightens up, the broader market desperately needs liquidity to fund core AI assets. Investors are actively rotating out of crypto and commodities to buy into the unprecedented, high-certainty growth of the AI sector. It's effectively absorbing all the oxygen in the room. To really put this into perspective, let's look at the timeline. It paints a very clear picture. We started the year in Q1 with absolute record gold buying by central banks. But then, by May, hawkish signals from the Federal Reserve pushed rate hike expectations higher, basically putting a lid on assets that yield no interest. By June, this tightening forced the market's hand, with massive AI unicorns hitting the market and massive capital expenditures required for infrastructure. The global liquidity pool just wasn't deep enough to support everything at once. So capital pivoted sharply and decisively toward AI. Moving to part two, Micron validates AI demand. Let's look at the undeniable corporate catalyst driving this market rotation. 84.9%. Just let that number sink in for a moment. This is Micron's staggering gross margin for their third fiscal quarter. That's up from just 39% a year ago. It completely shatters the ambient market noise and proves, beyond a shadow of a doubt, that in the AI memory space, suppliers currently hold extreme, almost unprecedented pricing power. And it doesn't stop there. Micron's overall revenue jumped over 4 times year over year, hitting a massive $41.46 billion. They absolutely crushed Wall Street's expectations. This specific level of hypergrowth is exactly what's sucking the capital out of the rest of the market. Now, the absolutely crucial takeaway here is that this isn't just a short-term, one-quarter spike. The data points we're seeing confirm a multi-year, locked-in runway. Micron has already signed 16 long-term strategic agreements, locking in orders and pricing floors for 3 to 5 years out. Management is clearly projecting that memory supply tightness will last well into 2027. And it's not just Micron either. The demand for capital to build out this infrastructure is so vast that South Korea's SK Hynix is seeking a staggering $29.4 billion US ADR listing, literally just to fund their own AI memory expansion. Looking at the future of this hardware ecosystem, there is a fascinating shift underway. While standard GPUs tend to dominate the daily headlines, look at the projected 2028 unit demand for custom ASIC chips. These are chips designed for very specific AI applications to reduce memory bottlenecks and lower power consumption. They are projected to hit 17.65 million units, actually outpacing GPUs at 14.57 million units. This broadening ecosystem means the infrastructure build-out is deepening, practically guaranteeing rigid support for the semiconductor and memory sectors for years to come. Okay, so we've established the macro environment and we've seen the undeniable corporate demand. But as an investor, you don't trade the macro, you trade your own account. With AI acting as a giant vacuum for liquidity, causing these violent swings in other sectors and even within tech itself, how exactly should your personal portfolio adapt to the volatility? That brings us to part three, cash as a strategic asset. Let's talk about building your most reliable defense mechanism. We need a serious mindset shift right now. You absolutely must stop viewing cash as a zero-yield drag on your returns. Look at these trading desk notes. Cash is not idle. It is the most stable third leg of your portfolio. In a market starved for liquidity,
Cash is your active risk buffer. It's your ammunition. It is the stable pillar that keeps you standing when the market violently reprices risk. So, to build a healthy portfolio architecture in this kind of climate, a strict, rule based approach demands maintaining a strategic cash buffer of roughly 12 to 15%. If your cash drops below this level, you essentially lose your agency. You become a victim of the market's unpredictable swings rather than an opportunistic buyer who can take advantage of them. Now, if you're looking at your account and your cash buffer is depleted, you need a disciplined plan for cash repair. Step 1 is identifying your weak or non-core holdings. Think about struggling software as a service stocks that are really just riding the coattails of the broader market. Step 2 is utilizing any market bounce to sell those specific assets to restore your cash reserves. And why do we do this? For step 3, to protect your core AI winners like Micron. You never want to find yourself in a position where a sudden liquidity squeeze forces you to prematurely cut your highest conviction long-term AI assets simply because you needed the cash. Finally, part 4, optimizing core AI positions. Let's look at navigating the chop with disciplined execution. You have to clearly separate your strategies here. For ultra-long AI core assets, think NVIDIA or Google, where the fundamental story remains incredibly strong. You can engage in core bottom fishing. This means utilizing left side buying, which is incrementally buying as the price dips. But you only do this with small, fixed budgets to dollar cost average, ensuring you don't burn through your capital all at once. Conversely, for leveraged or indexed assets like TQQQ, you must act as a trend trader. That requires waiting for right-side momentum, meaning you only buy after the broader market has actually confirmed an upward trend and held critical support levels. And we really have to hammer home the ultimate rule governing all of this. No matter how cheap a core AI stock looks on a red day, preserving your cash baseline is your ultimate survival mechanism. Never, under any circumstances, let your bottom fishing habit drain your cash reserves below that 10% critical threshold. If you violate this rule, your portfolio becomes incredibly fragile to the next macroeconomic shock. The global capital rotation is well underway, and the data is crystal clear on exactly where the money is going. The infrastructure demands of the future are heavily draining the excess liquidity of the present. So I'll leave you with this to consider. When the next wave of volatility hits, and for sure it will your personal portfolio be a casualty of the global liquidity squeeze, or will your disciplined cash management keep you safely fortified within the AI oasis? Thank you so much for joining me for this explainer. Stay disciplined, manage your risk, and I will see you next time.